Welcome, everybody, to the Chinchilla Pickin' Podcast. It is August the 17th, 2022. Happy Wednesday, hump day. As always, here on Chinchilla Pickin', we hope to be educational, uplifting, and encouraging because we want everyone to make money. My name is David Underwood, and again, as always, I am here with Brandon Beaver. I'm Brandon. I missed last week, but you rocked it out, man. You rocked it out.
Thank you.
Yeah, it's good show. I feel left out, but it was a good show, man. How are you?
You weren't here to rein me in. I'm all right. I just got done cleaning the blood out of my ears from listening to Target's conference call.
Wow. Yeah. So there was they had some rough numbers, but they weren't the only one that had some rough numbers today. And
No,
some companies had good numbers, but bad news. Whereas you saw a fundamental microeconomic versus a headline macroeconomic battle. And we'll talk about later on. I'm not going to give out right now. And so far, the macroeconomic headline is winning.
Here was my problem with Target's conference call. It was all rosy, completely contrived. The entire conference call sounded like one big infomercial for Target. And, they're all super excited and happy with their quarter, despite the fact that they missed earnings per share by like 50%. And operating margin was down 8% year over year. I mean, they had a bad quarter. But the entire time they're like, oh, we're so super stoked for like how we did. And we're so proud of everybody for achieving the things they did this quarter. And it's like, dude, your quarter sucked. Okay. I just gotten off the call with the Walmart earnings call. And that was a great call. And they were honest and you could tell that it was just a conversation. The CEO was telling you what he thought, was not contrived, was not robotic. They could have outsourced Target's conference call to robots. It could have been done AI. That's what it sounded like. It was, I was so bored out of my mind.
Yeah, I hate to talk over you because I get complaints from listeners like, when you talk over them, I can't quite hear. So I hate to do that. But when you hear that robotic earnings call, like such as you heard from Target, and you feel like it's not real, it's not sincere, they're just trying to push a propaganda message out. It just makes you want to sell and never go back in that stock again because you can't trust the leadership. Like, how do I trust you?
Yeah,
I don't know.
Anybody else who listened to it, I'm sorry. Usually there's two different types of conference calls. There's bad ones, there's good ones. There's in the good ones, I can usually listen to it, and then by the time they get to the questions, I have all my questions already answered. I don't have to listen to the questions. I can just turn it off. I was just like waiting for the questions to come up on Target, and those weren't even really that good either. But just hoping for something of substantial value rather than talking points.
Sometimes all they have is talking points, man. What do you say we get into this here? Hold on. If you're listening right now and you like what you hear, please hit that subscribe button. Go ahead and follow us on any one of our social media platforms that we are currently on. Feel free to reach out to us, DM us. Someone did reach out to us, and I do want to address this, about having a guest host on the show. They wanted a guest host. We are still looking into that. We did get your email. We will get back to you. It is just Brandon and I. We do not have a team behind us, so give us some time here. We are busy guys, but we'll do our best to get back to you on that. But if you are listening, you like it, please subscribe. Please let your friends, family know. Tell them all about us. Share it out there. And here are the rules. Brandon and I get together 5 to 10 minutes before the show, and we tell each other what we're going to talk about. We do not discuss it here. The live discussion here for you on the show. Brandon, since you have the most, do you want to take it away or what?
Yeah, we'll do a retail tale of the tape. The last time I did this back in November, things were a lot different, but the environment for retail has so significantly changed in such a short period of time that I feel like it's another good time to do a retail tale of the tape show. The last one was back in November, and I think I might make this a quarterly thing just because retail is so telling on the state of the consumer. So every 3 months, Walmart, Target, Kroger, they report earnings. We'll probably do a retail tale of the tape. Go ahead, Dave.
Is this going to be a Walmart versus Target, red versus blue?
Yes, Walmart versus Target, and we're going to talk about the health of the consumer. Right now, consumers are spending down their savings, which means that companies will not be able to sustain price increases, which that might sound good to some people that inflation is going to come down. However, excess government spending is being combined with a reduction in oil rigs this year and increased travel demand. This is keeping commodities still high. Okay. Oil's come down quite a bit in the past month, but it's still a lot higher than it was a year ago. And this is keeping food prices and consumer staple prices high. And this is putting a squeeze on the profits of these companies, and it's causing a profit recession. Profits are down across the board. Make no mistake about it. They could tell you that Walmart had a great earnings, but 2 years ago, 3 years ago, pre-pandemic, if they would have had these kind of results, then investors would have been apoplectic. It would have been bad, not good. So on Tuesday, Walmart reported second quarter adjusted earnings per share of $1.77 on a revenue of $152.8 billion. Both numbers exceeded the consensus analyst estimates of $1.62 and $150.8 billion, respectively. Revenue was up 8% from a year ago. However, that for the most part was driven by inflation. There's been a 132 basis point decline on gross margin, which I think actually was better than what was expected out of Walmart. That's only 1.32%, not too bad. And we'll talk about what happened to Target later. We could see how, Walmart's faring better than Target at the moment. About a quarter.
Hey, who said that? Who did anyone on this show call that? Do I remember a quote from someone on the show saying, I wouldn't touch Target or any of these other retailers with a long stick, but if you forced me to, I would buy Walmart? Was there someone who said that on this show?
I believe that was you.
I'm just saying, man, here we go again. If you're not listening to us, listen to us now.
Yeah. A study came out. This was something that hit the news yesterday. A quarter of Walmart's quarter two revenue came from customers that are making more than $100,000 a year.
All right. So, all right. Look, I if you're in that group and you're looking to save money, right? And you're looking for deals because you either are wanting to switch. A lot of people in that group are wanting to switch retailers. They're unhappy. They're looking for different areas. Walmart's grown in multiple areas. They're in there's a Walmart here right next to me in a very nice neighborhood. So they are in, those type of neighborhoods where you can get that kind of clientele. But I believe it's high inflation and, people are just looking for better deals. I believe that's mainly the cause of that. And Walmart is where they're going.
When you have people that bring in income of over $100,000 a year, penny pinching, things are not good.
Exactly. Yeah, sorry. That goes into what I'm going to cover later on, which is, about you can't have a booming economy and, low inflation right now. It's just not the way that the economic cycle works, man.
They said that the amount of inflation and the persistence of inflation is affecting people globally. Well, this is the whole interconnectedness that we have of the economy, the central banks, the global banks, all of that stuff. We're all sort of having the same problem. And he mentioned Latin America, Asia, and the Americas. So everybody's kind of going through the same thing. Some people are getting it worse. Food comps are up mid-teens for the quarter because of inflation. Now, on the other side of this, aggressive markdowns on non-grocery inventories putting financial pressure on them. This is a side effect of being pre-pandemic or post-pandemic. Go ahead, Dave.
So, before you got into like the side effect of being post-pandemic, which I know where you're going in, and I like where you're going, and I'm going to agree with you on it. I do want to say that, yes, everybody in the global economy right now is dealing with inflation in all sorts. Bank of England, so, you see the headlines coming out of the UK right now, and they're drastically trying to raise rates, and it's causing an actual recession there. So they're going to get through it because they're doing what you need to do to overcome these things. Everybody's raising rates except for who? Who's the only one who's cutting rates right now in the world of a
China.
major economy? China,
Yeah.
right? Why does China want to cut rates? Because they like inflation. They like their money to be devalued so that they can sell their goods cheaply to the rest of the world. They are cheating the system by purposely devaluing their money so they can continue to sell you cheap goods.
It actually happens. This happens to help the American consumer, though. I don't think that China and their leaders, I don't think they're as intelligent as other people believe they are, or as they believe themselves to be. They are impoverishing their own people by doing that. And they're helping us put a cap on our own inflation numbers. I've heard a lot of,
Yeah, there is that aspect to it.
yeah. So here's the other,
Inventories. You're at
yeah.
inventories. Sorry.
So non-grocery inventories are incredibly high right now, whereas 2 years ago, all inventories were super low. But the lead time on these containers that were ordered during the pandemic, some of them are just now showing up to U.S. shores, and this is a huge problem for companies right now that are trying to get rid of excess inventory in apparel and electronics. We are facing, in some cases, the exact opposite problem that we had a couple of years ago when nobody could get their hands on a Nintendo Switch or a PlayStation 5 or an Xbox Series X or a new computer. Now we've got excess inventory of all those things. And so markdowns are having to happen to try to just clear the stores, because the stores are just getting so cluttered with inventory, and we're trying to clear these things out. But the problem is they're not making any money on these markdowns. They're having to lose money on it because the cost of raw materials and the cost of oil is still high. And that's not going down anytime soon. And in fact, Walmart said they expect the inflationary pressures to last for quite a while. And they're also aggressively reducing container numbers. So just a year ago, we're talking about the lack of containers. Now Walmart's cut their container numbers in half just in the past 3 months.
Walmart also secured. Remember, they raised their dedicated drivers for their trucks, for their trailers. They raised their minimum start-in pay. That way, they can secure a fleet of drivers to drive their containers around. So Walmart is making the right moves that you want to see, but way ahead of time of everybody else. We reported on this way ahead of time of everybody else, and it's doing well. But who I also think is really going to be a big winner, Brandon, out of all this shipping and carriers is going to be what we talked about, which is like the AI carrier routes. Right now, you have Tesla having a route down in from Arizona to LA, from Arizona to Texas. You got routes of just the computers driving itself. Right now, there's still a human in the vehicle with him, but eventually they're going to get rid of that. And it's just going to be, you're going to see a truck driving down the road with nobody in the cab.
It's
and
pretty cool.
It's going to weird you out.
And it'll probably be safer.
It probably would be safer. But you're going to see more and more and more of these. You have Apple that's still in production of this, but you have like Google has Waymo taxis already in San Francisco, and they're operating and they're making money.
Yep.
And it's operating without a driver. I mean, so these things do exist. They don't exist everywhere. They're not in the middle of the country. They're only in cities like San Francisco, LA, New York. They do exist. They are going to come to truck driving, and I think those are going to be the big winners. So do you invest in Tesla? Do you invest in Google Alphabet because of Waymo? Do you invest in Apple for that reason? I mean, where do you go with this? Or do you go with Uber for the trucking business?
I think Uber's a good value. And they're one of the companies from probably a sector of stocks that I would normally not touch. They don't have proven sustainable profitability yet, so I don't normally touch those kind of companies. But Uber, I think, has a lot of potential.
I think if you're Google, you buy Uber.
It would be a good buy,
right? Because you could use the Uber service for your Waymo taxis.
Yeah.
And all of a sudden now you have a thing like China has that Baidu City, and they have these AI driven vehicles driving around picking up people. They hop in, there's no driver there. And it takes them where they want to go.
Yeah, And this is something that, like, global GPS really paved the way for this. I mean, if I'm
Yes.
driving down a route and there's a wreck, my phone notifies me and tells me there's a hazard ahead and gives me like the amount of miles that I have to get to there. And then also offers me a alternative route.
Right?
I love the future. Anyways, the shift to online during the pandemic and then the shift back to pre-pandemic normal levels was sharp and tough to predict, they said, which is why they're winding up with so much excess inventory in retail. You know, the people switched up. They're no longer buying their equipment for their homes, no longer buying the furniture and stuff like that. They're traveling. But then also they're being eaten up by inflation on the gas and food side. So they've canceled billions of dollars of orders for inventory to help align inventory with demand. Another thing, I mean, that switched so crazily and so fast in the past years. A year ago, you wouldn't see canceled orders of inventory. People were trying to get that inventory in. Now they're canceling it. 10 to 11 billion dollars in shares will be repurchased in the next 2 quarters. So that tells me that Walmart still thinks that they're a little undervalued. Gross margin pressure led to a decline in operating income of about 7%. And that operating income decline of about 7%, that's where I say investors wouldn't have been happy about 2 years ago. But I think right now it's just, it's kind of expected. Markdowns were hurting markdowns were hurting gross margin, particularly in apparel. Post-pandemic apparel inventory has been harder to get through than they anticipated. So I'm just kind of running through my notes here and just saying, just to paint the picture of how things have changed.
I think what happened was the retailers in the United States overreacted, and now they're overreacting to their overreaction. It's like if you're driving a car down the road, and all of a sudden you're like pull this to the left, you overreact to the right. Now we're trying to overreact back to the left, and we just keep overreacting, and nobody's doing the right measurement to get us back on track.
It's kind of, yeah, but it's really hard to come up with the measurement. I mean, we had so many different macroeconomic interventions from the government and from the situation with the pandemic that it's just so unpredictable. Nothing that is happening or that has happened in the past 2 years in economics has been rational or even normal at all. These are not normal reactions and they're not normal actions that are happening in the economy. So that makes it very hard to predict because it was something that hadn't happened in our lifetime and really in anybody's lifetime.
All right.
I mean, you had the 1920 swine flu or Spanish flu pandemic or whatever, but they didn't shut down the entire world over it. This is the first time that's ever happened. Go ahead, Dave.
All right. So you're saying we don't have normal reactions right now? Yeah. We had the COVID pandemic. It happened, everything. Even the CDC says we're on the other side of this and that we're going to treat it just like the flu basically going forward. So right now, what the reaction was this year, you forget, was the reaction to a Russia-Ukraine war and the sanctions put on Russia. And I think that was a normal reaction to a war, and to that type of war where we're putting sanctions on an oil-producing country. That's a normal reaction, what the market did at that time, and oil price shooting higher. We even called it here on the show. We said, if these things happen, this is what's going to happen, and it did. So that's a normal reaction. So there are some normal reactions to the macroeconomic events that are happening, and you can see it. It's just they're macroeconomic events, so they're not always easy to predict. They're actually very hard. They should be very hard to predict because they should be headlines of the day. You know what I mean?
Well, they're incredibly hard, but I mean, it wasn't just the Russia-Ukraine thing, though. So oil.
If you listen to all the earnings calls from like last quarter, that's all they ever talked about.
Yeah, they were blaming it. I know, but that was annoying. Like, I'm hearing Restoration Hardware blame Ukraine, and I kind of got it to a certain extent. They were planning a big expansion in Europe that they're still planning, but it really didn't hit them as hard as they were pretending it did. But we talked about this on the show. Oil is traded in dollars throughout the globe. The oil is traded in dollars. So the more you devalue the dollar, the more oil costs, right? So it's not just the Russia, Ukraine thing. It's also the fact that we have just literally piled so much money into our economy post-pandemic, via government spending, via stimulus paychecks, and all of that. This is the reason why we're getting taxed out of that money by inflation, and people are spending through their savings that they built back in 2020. And this recession is probably going to bottom once all of that excess cash is gone.
You know, and I hope that's sooner than later. I was thinking it would be October when it happens, but even Steve Leisman on CNBC said that we overspent our way into high inflation and we cannot spend our way out of inflation.
Yeah.
And I don't always agree with what Steve Leisman says, but in that statement, I agree with him.
Yeah.
Yeah, and
so,
it's a true statement.
So the Fed raising rates is going to help, but it's really not going to, we're not really going to bottom, and we're not going to really have the type of price declines until people can no longer sustain the price increases that have happened.
Yeah, and that's what it goes. So that goes. Let me go into my statement I said I was going to make and explain this for those of you who are new to investing or stock trading or just following economics, following the businesses. I want to explain a couple things to you right now. What's typically happened historically? This is true. This has always been true historically, and it's still true to this day. When you have high inflation, what most banks do and what all banks around all the major economies around the world are doing right now is they're raising rates. Why do they do that? They do that to slow down to the economy. You cannot have a booming economy and low inflation and bring inflation down. Sorry. You can't have a booming economy and bring inflation down at the same time because it's not sustainable. You have to either be okay with the high inflation where your money gets devalued month over month over month and have a booming economy, or you're okay with a slower economy. It slows down, but it fixes inflation. That's how it historically has always worked 100% of the time. And that's why right now I think that the problem is the Fed's trying to keep a booming economy and lower inflation at the same time. And I'm like, it's not possible. You can't do that.
Yeah, it's not. It's not. I think things are going to get worse. I see unemployment. My base case is unemployment at 5%. It could get worse than that if we wind up having a financial recession, if something goes under that's too big to fail or whatever.
5% inflation is just a typical recession.
I'm sorry, I meant to say unemployment.
Yeah, 5% unemployment. No, you said it right. I said it wrong. 5% unemployment is just a typical recession. It's actually probably at the beginning or the end of a typical recession. Typical recession probably sees 7 or 8% unemployment. So 5% is not that bad.
Not bad.
Typically in the United States, during good times, we have between 3 and 4% unemployment.
Yeah.
So the fact that we are so overemployed right now is another issue. In that, and this is what I said. I came on the show and I said this again a few months ago. I said, look, has to happen is people have to go ahead and accept the fact that they can't just trade jobs and get the job that they think they want anymore, right? We had the Great Resignation that happened in November of last year, started in there. It kept going for a couple of months. There was all these headlines, Great Resignation, Great Resignation. People got used to like, oh, I don't like this job. I'm just going to leave it. There's another job over here that pays 20,000 more a year. I'm going to take that one, or 50,000 more a year. I'll just take that one. And I said, like, at the beginning of this year, not beginning of this year, but once we saw the signs of recession happen, I said, that's going to go away. Then the next month, all the major companies started announcing hiring freezes, job cuts, hiring freezes, job cuts. They're still doing that. Then I got on here and I reiterated it again. I said, look, when companies are doing hiring freezes, job cuts, you cannot just go find another job somewhere else. You have to then accept the job you have that are offers in front of you. So what's keeping unemployment low is that people finally settled and accepted those jobs in front of them. Now, at every restaurant I've been to the past month, they've been fully staffed.
Yeah, because Meta, I mean, the tech
people gave up.
And they're too overemployed. I mean, Mark Zuckerberg came out and said that the other day that they have too many people on staff. And he said that if people choose that Facebook is not the company for them, he's okay with that if they leave on their own. Which of course he is, because then he doesn't have to pay out their own employment benefits. But
exactly, or severance
yeah,
package. So I mean, but I'm just saying, like companies are all over the United States just started doing job cuts and hiring freezes. It was everywhere, everywhere. You saw it at all the major companies. Even Google came out and said, "Hey, we're going to ask more of you guys
what a
because
change.
we're not going to hire and fill in. We're not going to hire 3 guys. We're going to ask, this one person to do the job that we would have asked 3 to do."
So what we're saying is that the new normal wasn't really normal.
That it ended, that we're
Yeah.
finally over that period, and now it's back to it's getting back to a normal economic economy here, and you're seeing it,
Yeah.
and let's talk about the new normal and things that happened during the pandemic that are just not quite working out anymore. So I want to talk about meme stocks. I know this is your favorite topic to talk about, and I want to talk about specifically about Bed Bath and Beyond right now. So Bed Bath and Beyond, back in March, Ryan Cohen, who he's on GameStop's board, or was he like a chairman or something at GameStop?
Chairman of something stupid.
Yeah, he's a C-suite at GameStop, so he's a C-suite, and he's over there, and he goes on in March, and he's like, "Hey, I just bought like a 11% of Bed Bath and Beyond. I believe in the company. We're going to turn this around." The meme stocks, Reddit started announcing it. People started buying it. Bed Bath and Beyond was going sky high, man. I think what it had like $22-24 a share, something like that.
Yeah. I had to light a cigarette for this one. Sorry.
So I mean, it just went sky high, and then all of a sudden today it was announced that Ryan Cohen go ahead and said that, oh no, I'm exiting my total position, his whole position, just gone. And
Congratulations.
they
Congratulations,
estimated he made $60 million. Thank you to the Reddit crowd for making Ryan Cohen $60 million. So much for being about stopping the rich. You just helped the rich get richer because you're falling for these guys getting on social media and saying this stuff.
That's exactly what I tweeted today. I was like, congratulations, apes. You made Ryan Cohen richer. Score one for the little guys, right?
Yes, exactly, man. Guy made $60 million because he played you. He played you. That's what it was.
He's going to continue doing it too.
I give him all the credit in the world, dude. He's making money doing this. So, hey, it's legal. There's nothing wrong with, there's nothing legally wrong with it. So, if that's what you want to do, man, you go right ahead. That's your thing.
He will pump that share price back up by spreading the rumor that he's not actually going to sell and that he hadn't sold yet. And then once it goes back up a little bit, he'll get rid of all sales, and then you'll see it decline again. All of his shares, He'll get rid of all of his shares, and you'll see it decline again.
It's a great move. Great move by him, man. Bed Bath & Beyond, so the earnings came out today, and they actually had pretty decent earnings. They beat the estimates.
Well,
stock was moving. Well, yeah, all right. So the stock was moving higher. So I saw the top line numbers. That's all I'm looking at was the headline numbers. Sorry, not top line, headline numbers. And they had beat the estimates. So everything looked great. The stock was moving higher, 10% higher. And then the news broke that Ryan Cohen was selling, and it just dropped. Last time I checked it, it went from like $23 a share down to $16 a share. Just like that. Wow. Just like that. And you guys all lost. And you're taking a risk. You're gambling because you're not actually studying the actual how to grade a stock. There's a great article by Brandon Beaver out there on the internet about how to value a company and how to value a stock. I suggest you read it, because today what we saw was a macro event, Ryan Cohen announcing it, versus micro event, the fundamentals of Bed Bath & Beyond's actual earnings report, and the macro event crushed them, killed the stock.
We got about a 2-minute warning here before this cuts off, and I got to resend you an invite, by the way.
Nice.
I hate how it's doing it, but yeah, or they didn't listen to the last episode that we did on Bed Bath & Beyond, where we detailed the fact that this company's been having problems since 2018. They're not a victim of the pandemic. The pandemic, of course, made it even worse, but They've been having issues since 2018 and declining revenue and declining growth and all of that stuff. And now it's we're at the point right now where Bed Bath and Beyond may be another retail casualty. It's been a
It
slow
may
decline.
be. It may be, but I mean, they had positive numbers today. So that, I mean, that was a plus for them. But I mean, they just changed the whole store that people don't recognize it anymore. It's not the same store that when you used to walk in 4 or 5 years ago. It's not the same kind of feeling that you have now. And I mean, I heard on my local radio station they were talking about how it's different and they don't like it anymore. I mean, that's a local radio station, dog, in Bed Bath and Beyond, saying this is not, it's not working for me. So I mean, they did some changes, and it's I don't see a bright future for that company at all.
Yeah, no.
But I mean, if the Reddit crowd owns the stock, they're going to keep it and hold it, right? Because look at GameStop. GameStop quarter over quarter over quarter and it goes worse. It's a straight down on those earnings. Those earnings, those EPS is getting bigger and bigger and bigger and bigger. They have yet to turn that around at GameStop. I don't believe they ever will. I believe that company is just going to go into disappear.
No, everybody's buying their games digitally now. And there's
Yep.
not really much of a margin on consoles, so the